Alright, we've now discussed everything from how the markets work, to the laws they're governed by, to key reference areas and what different types of price behavior at those areas mean, what kind of information they give us, and finally how to look at the market from different time frames and different perspectives within those time frames. By now, if you've been going through the sessions diligently and doing all the various drills, while developing your understanding by studying historical charts of the markets you trade, you should have a pretty solid foundation and grasp of how the markets work and how to read them, more so than most traders ever will know. Of course, the most important thing isn't just knowledge, it's skill building, which is why we stress doing your own studying, looking at a lot of different charts, looking at things from different perspective, learning from real experience, using this as the structure and foundation. And so now that we've given you this basic foundation and the big picture view of how the markets work and how to analyze them and how to dig deeper into specific areas, we're going to go one level deeper still and now talk about intraday market behavior, i.e. the market behavior that happens within one trading day. For the day traders out there, this is going to be extremely important information. For those who trade a larger time frame, let's say you take trades that are, several days to a couple weeks long, it'll still be very helpful to understand intraday market behavior because it'll allow you to time your entries and exits to a much better level, which will make a huge difference on your results. But for day traders, this is the crux. So having said that, let's get right into it. Okay, when we talk about the types of market days that develop, at the broadest level, we're talking about two major types of days. And it shouldn't be a surprise by now that we're talking about trends and balances. So, trend days and balance days. This is the most broad level. Does the day you're looking at display nice convictional trend movement? Or is it more of a range-bound day that balances, goes up and down, and stays in a narrow range? This is the broadest level. But since the markets are so complex and there's pretty much an infinite number of types of days that could unfold, it really helps to have some major categories onto the different types of days that could develop as broad outlines to kind of fit certain types of days into categories. This allows your mind to really be able to understand things better and to take a lot of complex data basically and put it in a mental box just to allow you to structure things better mentally and understand things much quicker. It's always easier to have certain types of categories and labels to put things in when you have an infinite number of variations. It's great to have certain concepts and labels to structure things. So let's jump into the charts and take a look at the different types of market days that can develop, what the implications of each are, and how you can have at times certain tells that help you be able to gauge which type of day is more likely to develop. Okay, here we are looking at a 5-minute chart of the S&P 500 futures. And what we're focusing on is this day right here. Okay. Now the first type of day, or the first category of day I want to discuss, is what I call the pure trend day, the high conviction trend day. Okay, and this type of day is the rarest type of day. Various traders have done studies over the years, and this type of day has been shown to basically happen around only about 2% of the time. But despite it being the rarest, it is probably the most important type of day. The day that if you're trading it, you trade this type of day, it probably has the most profit potential out of all days. And the day that from just a market analysis standpoint, which gives you a lot of information about who's in control of the market and potentially the kind of follow through that's going to happen in the days to come. So when we're looking at a pure trend day, the way basically that we define it is that a pure trend day opens on one extreme, moves directionally throughout the whole day, and closes on the other extreme. Alright, so in the case of an uptrend day, the day would open pretty much at its low, which it did. It had a small gap here, opened right here, and just took off. And this was the low of the day, the open. I mean, it doesn't have to be exact, like it's not like it has to be the exact tick, but opens, let's say, in the area of what eventually ends up being its low. Just opens and takes off, okay? And so it takes off, and just throughout the day, it just keeps making higher highs, all right? In pretty much every 30-minute period, you go up and you go higher highs, and then you hear higher highs, and higher highs again, and then again, right? And then it closes near the high. This is just pure directional conviction. In this case, the buyers just started out right in the morning buying aggressively and didn't stop all day long. Just kept buying, buying. Now, of course, the first thrust was the real directional move, and then it was slower, but still, it was still an upward trend the whole day long. Now, in case of a downtrend, it would be the exact opposite. And so here we're looking at a downtrend, and the day opens near its high, right? It opened here, this was its high, so again, it's not exact, but it's very close. Opens near its high, takes off to the downside, here it does a little balance, and then just keeps trending down all day long. At the end of the day, I had a small bounce, but it ends up closing near the low. So it doesn't have to close here at the low, but near the low. It's just a general visual thing, right? So this is a downtrend day, just trending the whole day down. Just lower lows aggressively. The sellers just keep pushing it down. Maybe a small midday rest here, right, where they do a small balance, and then they keep pushing it down. So it opens at one extreme and it closes at the other. This is a day, again, of directional conviction. One side is overpowering the other side all day long. Now, there are different types of trend days that aren't so, let's call the pure trend days, but they're still nonetheless trending days. For instance, take a look at this day right here on your screen, right? This day opened near the high and closed near the low. But it wasn't instant directional conviction all day long. What it did was it opened and balanced for the first almost hour, right? And then it took off down. And then it balanced the majority of the day, right, for 2 or 3 hours, and then it had a final push down at the end of the day. Some people will call this a double distribution day, which means that first there was, a balance here. They call that distribution, and then an imbalance, so a push out of it, another volume distribution here, and then a push out of it. Regardless, I don't want to get too technical with a lot of different categories. I don't like to get too deep into many different labels. I just like to look at these types of days as trend days in and of themselves, but not what I call the pure trend day, which is just instant directional conviction and just keeps going on and on with very small balances. Here we see the same type of thing in the case of an uptrend. We opened a very large gap up, we opened way higher, we thrust up, we pretty much balance all day long, and then we have one more push higher at the end of the day, right? So again, not the pure trend day of just continually rising prices, but still nonetheless, we open near the low, close near the high. And so now we go to the other extreme of things, which is the pure balance days, right? And this is what I would call a pure balancing day. This is a day that opened here, right? Closed here, very near its open, and had a very small range during the day. If you see, it just kind of went up, sideways, 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 sideways all day long. Didn't really do much. There was no trend, there was nothing there. And so this is what's called a range-bound day or a non-trend day. It's just basically a day where the market is balancing sideways. Even the one before it here is pretty much the same, just kind of sideways all day long. Yeah, there's a slight downward drift and a rise at the end, but pretty much open and close in the same area, just sideways. There's no directional conviction, right? This day tells you that buyers and sellers as a whole are balanced. Neither side can overpower the other, and they're just building value in this area. Now, often what these type of days will do, or what will happen in them, is the first hour, which we call the opening range. So this would be about the first hour right here. Okay, it'll kind of have maybe a directional move and seeming like this day is gonna go somewhere, and then it'll just the rest of the day will just balance right inside of that first hour move, won't make a new high or a new low, and will end up having really gone nowhere the whole day, right? So this is another kind of variation of this pure balance day. It just does nothing first hour, and then we bounce within that first hour all day long. And at this point in the training, we're just kind of characterizing the different types of days. Later on, we'll get into the different types of tells of how to gauge which type of day you're likely going to have before it develops fully, which is very important in being able to basically trade it. And being able to read things early will be a key trading skill that you'll develop. But for now, we're just going to talk about the major categories just so you have them in your mind and you kind of know what to expect into the different types of ways the market behaves intraday. And so now that we've looked at basically the two extremes, the pure trend days, the pure balance days, and slight variations of them, we go more into the middle of the different types of things that can happen with two more types of days that are kind of in the middle on a continuum, if you will. If there was a continuum that started with trend days on one end and pure balance days on the other, there'd be a couple different types of days in the middle somewhere. Okay, so the first of these types of days is what's standardly called the normal variation day. And the way we define a normal variation day is that the opening range, which again is the first hour of trading, and the range is from the high to the low of the first hour, the opening range, right, gets extended to one side of the market. So in this instance, we're looking at this type of day, right? The opening range eventually later in the day gets extended to the upside, right? The buyers take control, and the low of the day stays within the first hour. The opening range set the low of the day, but the market broke out to the upside. Now, what's important to recognize about here isn't so much the exact definitions of what it means, even though you should know those, but it's what's really happening beneath the surface. And what this type of day is telling you is that to begin the day, the market was balanced between buyers and sellers. They tried to push it down, formed a low, then went up, and kind of were balancing throughout the day, couldn't make one move higher or lower, and then at the end of the day here, in this instance, the buyers took control, right, and broke to new highs and closed it, in this instance, near the high. Now, the normal variation day can have a lot of variations. For instance, this push higher could have happened much earlier in the day, or it may not have closed, let's say, at the high of the day. Regardless, the whole idea that you have to understand of a normal variation day is that one side or the other eventually took control to one side of the market. And the opening range in the case of an upside breakout, the opening range had the low of the day, i.e. the low of the day, right, was formed within the first hour, and we could never break it all day long. The opening range was only broken to the upside. Now, in the case of the downside, the high would never be broken. Let's take a look at that. Okay, here we are on a normal variation day, but to the downside. This was the opening range, right? The first hour's high and low. Okay. And then buyers and sellers were kind of balanced all day long, and then here they made a slight push lower, and then finally near the end of the day they broke it down, right, and they took control of the market. The high of the day remained the high of the first hour. We only broke the initial opening range, right, to one side, which was to the downside. Now, why do we place so much focus on this first hour, this what's called the opening range? Well, the reason for that is, if you remember thinking about market participants, right? Institutions, which are usually the ones that move the markets, the ones with the major volume, they're usually most active in that first hour of the day. Usually they're coming in and sending their brokers and sending the orders in ahead of the market open, And when the market opens, that's when they start doing the majority of their trading, getting their trading done early in the day. And so often that first hour can set the tone of what's going to likely happen or establish an early range. And that's what usually happens. It establishes an early range. The high and the low of it establish a range, which they did here, that was eventually broken down. Now, it doesn't always have to wait until the afternoon to break the first hour range. It could happen right away, right after. But we just focus on that first hour because we know that's where the bigger players are usually most active, usually, right? And once we break to one side or the other, that's kind of telling us that that side that was able to go further to one side or the other is the dominant side, either the sellers or the buyers. Now, like I said, there's a million variations of these types of days, but it's just helpful to have that general idea of the push to one side of the initial range. So, for instance, this is a very different type of looking day. Here we opened up, we shot higher in this first hour, so it looked like it could have been a complete uptrend, right? Just directional conviction higher. But look at it, just instant rejection of it. The sellers came in and instantly rejected the whole thing right back down, right? So we formed the high in the first hour. And the sellers basically came in and said, no, this is too high. The buyers met a wall of these sellers. The sellers just pushed it right back down just as aggressively, right? And then they kept pushing it down straight below the low. They didn't balance, they didn't wait. So this day, the sellers took control of right after that open range and just kept pushing it down all day, right? And so they formed a new low beyond the low of the opening range. And what ended up happening though is that, even that was reversed by the end of the day, but they couldn't go break to the other side. The buyers could not go take it back up here. They couldn't make a new high. So the high was formed in the first hour, and the sellers did the most damage during this day based on how far the market had gone up. In the end, where it closed was right around where it opened, so not much headway either way. But it just helps to know what happened with regards to this first hour. And the key thing about this first hour here, right? And this is a very important statistic to take note of. In the index futures, we're talking about the E-mini S&P 500, the NASDAQ, the Dow, the Russell futures, and most likely in a lot of other markets, although I haven't seen studies done on the different types of markets, let's say gold, oil, or specific stocks, or even Forex, even though that's a 24-hour market. There are certain market opens, like when Europe opens or when Asia opens, that the Forex market starts having more activity, right? So you could think of that, even though it's a 24-hour market that trades all day long, you could think of that as it's open, even though it doesn't have a floor like the New York Stock Exchange does or like the Chicago Mercantile does. But I'm probably guessing that most markets adhere to this. It just happens to be a characteristic of market behavior, most likely because the bigger institutions do their trade within that first hour of the different market opens. The statistic is that you should take a note of is that the high or the low of the day is made within the first hour around 70% of the time. There are different studies that say anywhere from mid 60s to up to 80, but let's just say around 70% of the time, the high or low of the day is going to happen within the first hour. So that's why we keep looking at this. For instance, here it happened that the high of the day was the first hour. In the previous example we looked at, it was the low of the day that was in the first hour. And the reason this is so is because this normal variation day, which pushes only to one side of the high or low, for instance here it pushes to the low, it leaves the high up there. This type of day is the most common type of day. So if the most common type of day by far, and I think some studies I've seen by a man named Tom Alexander, who's a veteran of the markets for about 25 years. He's done some studies in a book he wrote called Practical Trading Applications of the Market Profile, which is a great book. And he did some studies about all the different stats of the different types of days and what kind of frequency we see each day. And the normal variation day basically happens about 50 to 60% of the time of all days. So 50 to 60% of the time, we're only going to push to one side of the market after this initial range. And when you combine that with the fact that trend days often just make the low in the first hour if it's an uptrend, or the high in the first hour if it's a downtrend, you add all those up, and that's why you get about 70 up to 80% of the time the high or the low of the day happens within that first hour. So this is going to be a very important statistic that helps with trading strategy later on. But for now, it's just good to note these kind of stats just to allow us to analyze what's likely to happen. For instance, if you see the market taking off here, right, and going all the way up, knowing that either the high or the low of the day happens within the first hour 70 or 80% of the time, initially, once it's going up, you might be thinking, well, this could be the low of the day, right? But at this point, when it gets rejected really hard and you're here, now you're thinking, okay, sellers have really rejected this area. They're in control. They just pushed it right back down. The likelihood with such a quick rejection is more follow through, as all these guys that have bought here are now forced to sell and kind of accelerate the move, right? And so now you probably expect this low to be broken before it even gets broken. And then once it is broken, right, at that point you can be fairly confident, maybe to 70-80% chance that this is now the high of the day. We're not going to re-break it. All right? So that's just something good to know. And that's the helpful nature of understanding the different types of days. Understanding that this is a normal variation day that just broke out to one side gives you a decent guess that this high is probably not going to be taken out later. Here, for instance, it's the opposite. The low of the day came in the first hour. We pushed prices down initially. We balanced. We tried to push them lower. We start seeing all these shadows on these candles. And every time they go down, they reject them quickly higher, reject them. So the buyers are active in this area. And we end up pushing to the upside higher than the initial high of this opening range. And we go up, we balance, and then we have a major push near the end of the day. So again, the first hour proved to have the low of the day, and this was a normal variation day to the upside. The variations of these are endless. It's very important to kind of go through your charts and start gauging these different types of days. Go through your charts and check out how many times the high or the low happens within the first hour. It doesn't have to be, even if you're not trading the S&P 500 futures, even if you're trading all the gold or oil, or if you also trade stocks or forex or whatever it may be, go through day after day after day, right, and check that out. Now, of course, you'll have to have your chart set up for the day session only. It can't be a 24-hour chart, because if it is, the market open and close are not going to be distinctly shown. Let me show you what I mean. Okay, this is a 24-hour chart, for instance. I'm looking at a 5-minute chart, and I have it set to the 24-hour setting, right? And there's no gaps. There's no places where the market stopped trading, except for very brief time after the market closed for about 15 minutes. But you see, it's just continuous. Now here, it's very hard to see the open and the close. Now you can see them through volume. You'll see that here there was a lot of volume. The market closed. During the night session, the after hours trading, there's pretty much no volume all this time. And then here we open again, and here comes the volume. But to really see the day types and those other stats play out, you put it on a setting that shows you the market's floor session that you're trading. If you're trading stocks, it's New York Stock Exchange, 9:30 a.m. till 4 p.m. If you're trading the S&P 500 futures, it'll be 9:30 a.m. Eastern to 4:15 p.m. Gold will start earlier, so will oil, so they're all different. But you'll want to set whatever instrument you're looking at to its pit session hours to its floor trading hours. Alright, and so we move on to the final day we're going to discuss here, the final day type, and this is called the neutral day. Now the neutral day, as you might have guessed, is a day in which the market breaks to both sides of the initial range. And so with this example, the market had opened here, set a high on the first hour, set this low of the first hour, right? Then we broke below the low of the first hour, and then these sellers got rejected, buyers bought it up, right? But then we also broke above the high of the first hour, and we end up settling somewhere here. The reason why it's called a neutral day is because both the buyers and the sellers take their turn throughout the day, right? Each of them at one point or another is the dominant side, and they both extend the opening range to one side or the other. So in this instance, the high or the low does not happen within the first hour. First, sellers take them down here. They are the aggressive side, but then they get rejected, and buyers become the aggressive side. And again, in this type of day, you're going to have many different types of variations. For instance, here, at the end of the day, since the previous day had closed here, right, and we had closed this day here, in general, if you look at this, even though it's called a neutral day, in general, we can see that it was more of a bullish day, and the buyers had the more control at the end of the day as an aggregate. But it's called a neutral day because the sellers really took their turn and were able to push it below this first hour range too. Here we see another example of a neutral day, and now it's more of a really neutral day. Market opens here, it's just sideways all the time, drops down hard, midday, gets rejected quickly by the buyers, and this thing shoots up and forms a new high, right? But then also that quickly gets rejected, goes close to forming a new low, quickly gets rejected. So if you see this type of day, the buyers and sellers are just taking their turns. One side becomes aggressive, the other side says no, value should be the other way. They get aggressive, the other side rejects them, and it ends up being neutral. It's neutral because no real direction is decided. They're both taking their turns. Here we see another example of it. In this instance, where the high and low are set in the first hour here, the buyers only break above it very slightly, right? They try to, but they can't, and then we form a new low. This, if you're trying to get too technical, you could say this was a normal variation day because they barely poked above this high. But if you're sticking to exact definitions, this would be a neutral day because they did take this early high out slightly. In the end, when I'm trading, I'm not really focused. Was it a normal variation? Was it a neutral day? It doesn't really matter. It's not going to make much of a difference if you call this one or the other. These things are just to help you structure things in your mind so all these days don't look like a mess. So when you're starting out, you're thinking, well, is this a trend day? Is this a day that the higher low is going to be formed within the first hour? Are one side going to push it beyond an initial range or not? Or is it just going to be pushed to both sides? Or is it just not going to do anything all day long and stay within the first hour range? That's what you have to be thinking. It's not so much about the labels. The labels just allow you to understand and remember these things better. But it's more about what's happening beneath the surface. That's what I want you to focus on. Not so much the labels. Just use the labels to help you remember the concepts. Don't get too fine-tuned about what is this or what is that. It doesn't really matter at the end of the day what you label it, right? What matters is while you're trading it during the day to just know which side is the dominant one, what are the likely high and lows going to be, and where we're likely going to extend to which side or the other. That's really all that matters. Finally, in terms of a few stats of how often these days occur, of all these days, all the day types that is, we had already discussed that the normal variation day is the most common type of day, which happens around 50 to 60% of the time as found in a multi-year study done by Tom Alexander. The next most common day is the neutral day, which happens around 25 to 30% of the time, so this type of day. And as you'll notice together, the neutral day and the normal variation day pretty much make up about 80 to 90% of all days, right? The rest of the time is pretty much split up between the different types of trending days and the purely sideways balancing days. In general, the pure trend day only happens about 2% of the time, where we open one extreme, just go all the way straight, pretty much straight line to the other side. That only happens about 2% of the time. Anywhere between, let's say, 5 to 10% of the time, we get that other variation of the trend day, which is not straight movement, but maybe a bit of balancing, then movement, more balancing than higher, but or lower in case of a downtrend, but still the extremes, the high or low, we open near the high, close near the low. In case of an up move, open near the high, close near the low. In case of a down move, those generally happen the rest of about 5 to 10% of the time. And then finally, you have those pretty much straight balancing days. Those can also happen around 5 to 10% of the time. The reason why the percentages are not exact is because market conditions change, and as we get different phases of market conditions in different types of years, these numbers will change around a bit. That's why I give you ranges, that not like something that adds up to exactly to 100%, but just ranges of where these can go in between. But that's good enough. Again, there's never anything that's purely precise in the markets, and having these stats really helps us out. It really helps us to know the likelihood of certain things happening. Just the stat in itself that 70 to 80% of the time the higher the low happens within the first hour is a great stat. Another stat is that even in the first half an hour, almost half the time we get the high or the low of the day. Right? So the first half an hour is the important part of the first hour. So something around 40 to close to 50% of the time, you get the high or the low of the day within the first half an hour. When you extend it to the full hour, it becomes about 70 to 80% of the time it happens. And then you have these stats for how often each type of day occurs. So you know that don't go into most days expecting a pure move straight up or straight down all day long, no matter how bullish or bearish you think the environment is. That only happens about 2% at a time. And there are tells that give you a heads up that it's much more likely to happen, which we'll get into later, but for now, those are good things to keep in mind. And I hope that this session kind of opened your mind and eyes up to the different types of ways the days can form, the different kind of frequencies we get in them forming, and this will really help you be able to gauge intraday market behavior better, especially when then we take all this and put it in the context of the bigger picture, which we'll also get into later. But for now, this should serve as a good foundation going forward.